Have you ever stopped to think about how the Federal Reserve, the U.S. central bank, is reacting to all these job and inflation numbers turning everything upside down? Recent reports show a shaky market, and with every new announcement, the Fed seems more and more nervous. This directly affects your investments, your home, and even the price of your morning coffee. So, like, comment, and share this video to help more people understand how this game is really played. Labor market reports and the Fed's reaction. Job market reports are like thermometers for the economy. They measure whether things are heating up or cooling down. First came the ADP report, which showed only 145,000 new jobs in May, below the expected 160,000. That disappointing number raised concerns that the economy might be slowing down. But right after that, the Labor Department released its own report showing that actually 272,000 new jobs were created, way above expectations. This sudden flip, first pessimism, then optimism, has left the Fed in a tough spot. Is the economy overheating or cooling too quickly? This kind of back and forth creates tension not just for the Fed, but also for global markets. Historically, the Fed relies on these reports to decide what to do about interest rates. And these swings in data bring dangerous uncertainties for anyone trying to plan financially. Bad decisions can lead to more than just market volatility. They have real impacts on your wallet and your daily living costs. Imagine a driver seeing a green light, then a red light, and then green again. How do they know whether to speed up or slow down? That's the dilemma the Fed is in. For many investors, this analogy helps explain why the central bank has to be so careful to avoid causing major economic crashes. Role of the Federal Reserve, Fed. The Federal Reserve has the power to adjust interest rates to try to keep the economy in balance. Cutting rates makes loans cheaper, which boosts spending and investment. Raising rates does the opposite. It cools down inflation but can slow the economy. This tool is one of the most powerful any central bank has, directly influencing everything else in the economy. But it doesn't stop there. The federal government, currently led by Trump, has been pressuring the Fed to cut rates and give the economy a boost. They want people to spend more and for businesses to thrive, which is especially important in an election year. Fiscal policy and monetary policy end up in a kind of tug-of-war, where it's not always the most technical arguments that win. But the Fed has another concern: inflation. Import tariffs, for example, can drive up the prices of essential goods. Right now, the average rent in cities like New York is over $3,000 a month, and the average monthly cost of basic groceries, like rice, milk, and meat, has reached $350 in 2025. These increases hit the purchasing power of millions of families directly. So, the Fed is in a tight spot. If it cuts rates to please the government, it risks fueling even more inflation and hurting families and businesses. That's why their decision goes way beyond politics. It's a balancing act that affects all of us. Even if you think you're not an investor, you'll still feel these changes in your electricity bill or the price of gas. Interest rates and inflation dynamics. To understand what's at stake, let's simplify. Cutting rates is like throwing gasoline on the fire of the economy. Everything heats up. It makes loans cheaper, which encourages spending, but also risks higher inflation. It's like giving the economy a little push, but with the risk of losing control. For example, if the Fed cuts rates, mortgage rates drop. More people buy homes, as we've seen in the U.S. and Europe in recent years. This heats up the housing market and drives prices up. For current homeowners, that's great. For those trying to buy, it's a huge challenge. In Europe, rates have been cut 10 times in the last few years to try to stimulate their economies. In the U.S., in 2024, rates were only cut by 1 percentage point, and in 2025, they haven't moved yet. This shows that the Fed is acting much more cautiously than other central banks. This more conservative approach also shows their concern about possible bubbles or future crises. When you think about your own finances, it goes like this. Lower rates equals cheaper credit equals more spending equals prices go up. And then everything comes full circle. Inflation and the risk of economic bubbles. In the end, it's all connected. Whether the Fed cuts rates or not, you'll feel the impact at the grocery store and in your rent. Uncertainties and disputes. These disputes are at the heart of why the Fed is so nervous. Import tariffs are driving up the cost of key products. For example, steel and aluminum are 15% more expensive in 2025, impacting everything from cars to food cans. These increases create a domino effect that eventually reaches you, even if it doesn't seem obvious at first. Trump wants low rates to boost GDP and get good numbers for re-election. The Fed, on the other hand, wants to avoid that, leading to runaway inflation that would squeeze families with higher rents, gas prices, and grocery bills. These opposing views create a dangerous deadlock because the decisions affect millions of people. Meanwhile, investors are caught in a tug-of-war. Some think the Fed won't cut rates at all in June, but that a small cut might come in September. This uncertainty creates opportunities, but also lots of risks. After all, if you make the wrong call, you could lose a lot of money in just a few weeks. And this tension isn't limited to the U.S. The whole world is watching because the Fed's decisions ripple through global markets, from oil to Bitcoin. It's a game that goes way beyond American borders. Market and economic impacts. Every Fed decision is like a giant domino that can shake up the stock market, housing prices, and the entire economy. If the Fed decides to cut rates, stocks like Apple, Tesla, and Amazon could surge because cheap credit boosts profits and innovation. But the excitement could be short-lived if persistent inflation follows. At the same time, rate cuts can push up home prices and rents. In cities like London, the average rent for a two-bedroom apartment has already reached £2,400 a month in 2025, a 10% increase over 2024. These jumps make life even harder for those looking for a place to live. So the stakes are high. A rate cut could mean immediate growth, but also a bigger risk of inflation down the road. And the Fed's final decision will rock everything. Businesses, consumers, and even other governments around the world. That's why keeping an eye on these moves is crucial for any investor. When we talk about impact, it's not just stock charts. It's your wallet, your rent, and even your job that could be online. You can't afford to ignore it. Investor strategy, given all this uncertainty. Here's one practical piece of advice. Don't try to guess what the Fed will do. Instead of speculating, focus on owning solid, diversified assets. That's what big investors do. And there's a reason they sleep better at night. History shows that big crashes are always followed by recoveries. Look at 2000 with the dot-com bubble, 2008 with the subprime crisis, and 2020 with the pandemic. Despite everything, the market recovered and kept growing. Those who invested with discipline reaped huge rewards, even after the worst crises. The best strategy? Keep buying good assets, even during downturns. It takes discipline and patience, but it's the best way to protect your wealth from any Fed-induced turbulence. Every market dip is really a discount for long-term investors. When you understand that the biggest mistake is to stop investing altogether, you'll see that the real risk isn't the Fed, it's your own decisions. Because investing is a habit, not a bet. Long-term investing philosophy. Here's the philosophy that separates amateurs from real investors. Discipline. Set aside part of your money to invest every month, no matter what's happening in the markets. Because if you only invest when things feel calm, you will miss out on the biggest returns. There are two styles: active investing, where you research companies, study reports, and look for opportunities. Passive investing, where you put money in index funds like the S&P 500 and let the market do the work for you. Both have their pros and cons, and the right approach depends on what suits you best. Both work, but the most important thing is to focus on buying quality assets and using downturns as buying opportunities. That's what Warren Buffett did, and he always says, "Be greedy when others are fearful." He knows that collective fear is a chance to build real wealth. In the end, what matters isn't predicting the Fed's next move. It's building a portfolio that can handle any move. And that's totally within your control. Tools and resources mentioned. If you want to stay informed without wasting time, check out newsletters like Market Briefs. They break down everything about the economy, stocks, real estate, and even crypto. These newsletters help you cut through the noise and focus on what really matters. For those who want to dive deeper, Briefs Pro offers more advanced analysis and investment ideas. But be careful, it's not for everyone. It's more technical and requires discipline and study to make the most of it. These resources help you stay focused on what really matters, without getting lost in headlines or political drama. And today, good information is more valuable than ever. In the end, remember, knowledge is power. The more you study and prepare, the less nervous you'll be, even when the Fed is. So yes, the Fed is definitely getting nervous, but that doesn't mean you have to be. Understand that interest rates, inflation, and political disputes will always be part of the game. The secret is to keep a solid strategy, invest with discipline, and see market dips as buying opportunities. Like, comment, and share this video so more people can learn how to protect their financial future. And remember, your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth building strategies.